start of the new year and a new decade, a lot of folks are making big long-term predictions. Well, that is exactly the bailiwick of my guest today, Gerald Celente. He's the director of the Trends Research Institute. Gerald, you don't think 2010 is going to be a very good year. You're talking about a depression coming this year. Obviously, that the worst is not over yet. What are you seeing that's telling you that?
What we're seeing is that when we said the markets would collapse in March of 2009. We said that in 2008. They collapsed in 2009.
Yes, they did.
But rather than hitting the ground, the Federal Reserve and other central banks around the world propped them up. You look what's happened since then in the last 11 months. Over $11 trillion has been lent, spent, or guaranteed by the federal government. Christmas Eve, what did we see? We're into Fannie and Freddie for $400 billion, and we're going to give them 3 years more money, all they need to cover their losses. And then there's H.R. 4173, guaranteeing $4 trillion in 2010 for the too big to fail's failing. You just can't keep printing the money out of thin air.
No, you can't, but the printing that they did, as you say, support the markets, and the market lifted. So did you underestimate the ability of the Fed and central governments around the world to reinflate, quote unquote, the economy?
Oh, yeah, we never thought they would do it. We never thought that we would be buying companies like AIG. We never thought we'd own parts of General Motors. GMAC just got another $4 billion infusion. Yeah, the government's never done these things before. So, yeah, we can't predict, nobody can predict the future. There are these wild cards. But the game doesn't change. The hand may change, but the game won't change.
So can they keep the game going, though, for another year, 2 years?
They can. They could do anything. Anything could happen. It could be a war. It could be anything that the government grabs more and more control and takes another angle. But it's still not going to prevent the inevitable. You need a productive capacity. You need to make things and sell things. You just can't print money.
So when do you see the house of cards coming down? And I guess you're saying it's this year.
Yeah, we think. Yeah. And we're looking again. Look globally. Look what's going on. Lithuania, Latvia, Estonia. Now Iceland, of course, is in the news. They're defaulting on their debt, on their bank loans.
Greece has got a lot of problems.
Greece, Ireland, Spain.
Dubai, right, of course.
The numbers just came out on unemployment in Europe, 12-year high. So, no, bye-bye Dubai. Dubai, by the way, is the canary in the commercial real estate cage. All that overdevelopment and commercial, that's going to be another wave to hit. But again, they just keep propping it up, rather than letting it fall and wash through the system.
Aren't, though, the macroeconomic signs turning more positive or certainly less bad? I mean, doesn't that tell you that maybe we're on the road to improvement?
Well, again, they're less bad, but it's a stimulus recovery. That's all it is. Go back to the 1990s. Bill Clinton gets elected on the mantra, it's the economy, stupid. We're in a severe recession, getting worse. All of a sudden, the game starts changing. What happened? The internet revolution. Everybody's life was different. Products were invented, designed, manufactured, serviced. Everything changed a productive capacity. You can't print your way out of this. There are people that think you can. We don't.
Right. So I know it's maybe too hard to talk about in detail here, but what are you basing your forecast on? Because we have guys who come in here talking about Fibonacci patterns and Elliott wave patterns. It doesn't sound like that is... You're not talking about technical patterns and wave patterns and things like that. No. What do you base your work on?
Current events form future trends. We monitor the globe to see what's going on a daily basis, but we always make connections between different fields. So the economists, for example, they only look at economic data.
Right.
They keep crunching it. We look at political change, social change, changes in the family, consumer habits, on and on and on, always making connections. There's three worlds out there. There's the media world, the political world, and the real world. And you start looking at the real world, you start getting a different picture. And the real world is, bankruptcies are up 79% in Arizona.
Foreclosures are coming back, right?
In bankruptcies in California, Nevada, 60% increases. These are huge numbers. Let's look at the numbers in trade. China in 2009, they don't export, they don't make it. They're off 20% globally. World trade's off. Those are huge numbers. What's sustaining it? Well, China has thrown trillions into the system with easy lending and stimulus. And now they're starting to
tighten a little bit, yeah.
And now what's going to happen when interest rates go up?
Right. So again, so you look at the big picture, and you don't see things necessarily on a sustainable path to getting better, basically. Because a lot of people look into the big picture, say the stock markets are up, industrial production around the world is recovering, unemployment maybe is starting to improve here in the United States. You look at the big picture and you see worse times coming down the pike, basically.
Let's talk about unemployment. We have to create 1.25 million jobs a year just to stay even,
right,
accounting for
population growth
in this country. So they're happy that the number's down to 430,000.
Right.
Yeah. So no, it's not. Again, when you look at the total picture, it's not very good. And again, we're going into debt levels that we've never seen before in our lifetimes, in modern history. This is brand new.
All right. So we're going to leave it there and talk about what that means for us as average Americans the next segment. Gerald, thanks for that.